We have very many LuxAlgo indicators in Tradingview that shows entry levels, and to be honest, nothing worked for me until when I came across this mind-blowing ways of looking for super-duper entries in Forex. So, traders, kindly listen to this.
You always get stopped because you don't use confirmation as a confluence. Let me explain. See, most traders enter right away only to get stopped out because they're too afraid to miss the move. Yet the truth is, this happened because there were no confirmation used. But enough said. Here's how you put an end to this. First, you need to make sure that whenever price takes out liquidity, it breaks structure at the impulse high, which led to the liquidity run, not just any random structure break. This ensures that price has truly shifted gears from moving lower to moving higher. Then, you want to see price show a willingness to want to continue moving higher, after which you can finally enter the fair value gap with peace, knowing that price will move in your favor.
Now, let's analyze this because that is our job as traders. He is talking about confirmation and confluence. Yes, this is all you need for you to execute trades because you cannot buy or sell for the sake of doing that. Confluence trading is when you combine more than one trading technique or analysis to increase your odds of a winning trade. Confirmation on a chart describes a chart pattern that shows a sustainable stock trading opportunity, which by virtue of its persistence is confirmed, given credibility. To get better entries, he makes sure 1. Price takes out liquidity. 2. He ensures there is a break of structure at the impulse high leading to a liquidity run. Now, what is liquidity in Forex? Liquidity refers to how active a market is. It is determined by how many traders are actively trading and the total volume they're trading. What happens when market enters a liquidity zone? Liquidity zones indicate an increased interest in purchasing or selling currencies in the Forex landscape. This concept reduces the unpredictability factor of Forex, giving investors a measurable insight into what's happening in the market and which currencies are in high demand or supply. Once the liquidity zones are formed, it is much easier to develop successful trading strategies, as investors are aware of the current market demands and can formulate immediate price predictions. Identifying the liquidity zones will swiftly eliminate any illiquid currencies in your potential strategies, letting you develop trading tactics with a higher chance of execution and profitability. Naturally, identifying liquidity zones is just the beginning, and it doesn't guarantee outright success, but liquidity zones are vital in making informed trading decisions. What is break of structure in Forex? A break of structure, BOS, is an integral concept signifying trend continuation rather than its weakening or reversal. In essence, a BOS occurs when, within the context of an uptrend, the market creates a new high beyond the previous peak without breaking the previous low. In other words, the weak resistance has been broken, forming a new high and signaling the bull trend is continuing. Similarly, in a downtrend, a BOS is identified when a new low is established lower without moving beyond the prior high. This pattern underscores a continuation of the existing direction. How to identify a break of structure? Identifying a BOS, as dictated by the break of structure theory, starts with discerning the current trend through an analysis of existing peaks and troughs. This involves observing whether there are consecutive higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. It's crucial to recognize that structure can vary across different time frames. A pattern appearing bullish in one may be just a corrective phase within a broader bearish movement on another. To accurately identify a BOS, traders focus on pinpointing key swing points, the strong swing point, which shouldn't be breached for the trend to remain valid, and the weak swing point, which is expected to be surpassed if the trend continues. A genuine BOS is confirmed when the price not only trades through but also closes convincingly past the weak swing point, marking a new high or low in the trend. While a wick beyond this point can suggest a BOS, it's considered less reliable and might simply be an attempt at a liquidity grab. What is liquidity run in Forex? Let's start here for better understanding. High resistance liquidity run. A high resistance liquidity run is a scenario when price struggles to sweep out liquidity and takes a long time to reach an old swing high or swing low. This happens when a liquidity level is defended by many resistance levels. For example, if price is making higher highs and higher lows, with a clear and one-sided up move after running sell-side liquidity, it would be difficult for price to drop all the way down below the long-term low, long-term high in bearish scenario, to take those stops out because there are many resistances, except on red folder news days, NFP, FOMC, CPI. Note that high resistance liquidity run is often viewed as less favorable conditions for trading, because the draw on liquidity of the trader is hard to reach. Low resistance liquidity run. In contrast, low resistance liquidity run is when aggressive acceleration happens, leaving liquidity void or FVG. Price moves quickly and easily through areas of liquidity because there are fewer resistance points. If price were to take out sell-side liquidity, short-term lows should easily be run through, but short-term highs should be defended. In contrast, if price were to take out buy-side liquidity, short-term highs should easily be run through, but short-term lows should be defended. Low resistance liquidity runs are the most ideal, easiest conditions to trade in the market. Targeting low resistance liquidity is much higher probability. It is the easiest area to trade in price action. These trades will feel simple, quick and effortless. It will take price minimal effort to sweep areas of liquidity. Note that the institutional order flow is important. If there is a bullish institutional order flow and price created a long-term low, every swing high should be seen as low resistance liquidity run and the long-term low as high resistance liquidity run. However, if institutional order flow is bearish and price created a long-term high, every swing low should be seen as low resistance liquidity runs and the long-term high as high resistance liquidity run. 3. He ensures as well, there is another promise that price is going to push to the upside. Here, we found a fair value gap. This confirmed price is going to buy. I have talked a lot about a fair value gap in this channel. That's all, traders. Let me hope you have learned something. Don't forget to subscribe, like and share. I will see you in my next video.
You always get stopped because you don't use confirmation as a confluence. Let me explain. See, most traders enter right away only to get stopped out because they're too afraid to miss the move. Yet the truth is, this happened because there were no confirmation used. But enough said. Here's how you put an end to this. First, you need to make sure that whenever price takes out liquidity, it breaks structure at the impulse high which led to the liquidity run, not just any random structure break. This ensures that price has truly shifted gears from moving lower to moving higher. Then, you want to see price show a willingness to want to continue moving higher, after which you can finally enter the fair value gap with peace, knowing that price will move in your favor.